Hey everyone, welcome back. Today we're jumping right into a brand new explainer, and we are looking at a seriously fascinating player in the Indian financial sector, MAS Financial Services, or MASFIN. Look, if you're the kind of investor who loves tearing apart high-growth businesses to figure out their secret sauce or, what might eventually trip them up, you are definitely in the right place. We're going to put MASFIN through the ringer today with a rigorous fundamental evaluation to see if it actually deserves a spot in your long-term portfolio.
But before we get into the weeds, welcome to Stress-Free Investing Analysis Personal Notes. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions.
All right, so here's our game plan. We're using a comprehensive 100-point rubric today. Number 1, we'll look inside the business model. Number 2, we'll crunch their financial health and numbers. 3, management quality and governance. 4, valuation and future risks. And finally, number 5, we'll reveal the final scorecard. Let's kick things off with Section 1, inside the business model. So what is MASFIN's actual edge here? Well, most non-banking financial companies just open a bunch of branches and start lending, right? But MASFIN runs this really distinctive hybrid NBFC partner model. Here's how it works. About 70% of their assets under management, or AUM, is generated through their 200 direct retail branches. But the real magic? That's in the remaining 30%. They originate these loans through a network of roughly 190 smaller NBFC partners. And crucially, those partners provide a partial credit guarantee. It's a 15-year-old system, and it acts as this massive economic moat. Essentially, it builds a natural shield against systemic shocks because the partners are the ones absorbing that crucial first layer of risk. And when we break down exactly who they're lending to, it gets even more interesting. Out of their FY26 AUM, which just crossed a whopping 15,304 crores, by the way, 40% is micro-enterprise loans and 36% is SME loans. Add that up and you've got 77% of their total book tied directly to MSMEs. Why is that absolutely crucial? Well, lending to micro, small, and medium enterprises gives MASFIN preferential regulatory access to priority sector lending, or PSL, and that is a huge structural advantage when it comes to refinancing and co-lending. Okay, so the model is clearly robust, but moving to Section 2, financial health and numbers. Let's see if a 30-year track record actually translates to a bulletproof balance sheet. Honestly, the historical numbers here are just wild. Over the last 10 years, they've churned out a 21% compound annual growth rate in revenue, a 23% CAGR in profit after tax, and a 19% CAGR in AUM. That is the definition of historical compounding excellence. And remember, they did all of this while navigating demonetization, a global pandemic, and some serious microfinance sector stress, all without posting a single year of loss. No way you can ignore that kind of resilience.
But no business is flawless. We have to look at the entire picture. They've got some obvious financial strengths, like a sector-leading net interest margin of 7.4% and a rock-solid capital adequacy ratio of 22.84%, which actually just got backed up by a CARE rating upgrade to AA-. But here's the catch. There is a glaring lag with their return on equity. It's totally stagnant at around 14%. And the real issue there is that 14% sits just a hair below their estimated cost of equity, which is somewhere around 15 to 16%. So long story short, even with fantastic margins, they desperately need to scale up that AUM to get the operating leverage required to finally push that ROE higher.
And of course, we can't talk banks and NBFCs without talking asset quality. 2.57%. That was their gross Stage 3 non-performing asset percentage in Q4 of FY26. It's definitely elevated compared to where they were before 2023, and that's mostly thanks to the recent stress in the MSME sector. Now, the silver lining is that this number is plateauing. It stayed in a pretty tight range for the last 4 quarters. But, and this is a big but, their provision coverage ratio is sitting at only 42%. So that 2.57%, yeah, it's a metric we absolutely have to watch like a hawk. Moving right along to Section 3, management quality and governance. Because at the end of the day, a company is really only as good as the people steering the ship. MASFIN has been led by its founder, Kamlesh Gandhi, for 3 decades, 30 years of operating continuity. And the corporate governance signals we're seeing, incredibly strong.
For starters, 0% promoter pledge. None. That shows massive skin in the game and total confidence. Their core philosophy is strictly to extend credit where it is due, and they actually mean it. They aren't afraid to slam on the brakes when market stress flares up, which we just saw them do in their micro-enterprise segment. But maybe the most impressive thing? We scored their guidance delivery track record at a 9 out of 10. Basically, when this management team promises something, you can pretty much take it to the bank. All right, Section 4, Valuation and Future Risks. The business is solid, sure, but what is the broader market pricing in right now? And what's the worst-case scenario? This brings us to the million-dollar question. Is MASFIN just a massive value trap? Think about it. Over the last 5 years, the stock price has essentially flatlined, drastically underperforming the broader market. And it did this while their earnings were actually growing. So what happened? Well, their price-to-earnings ratio compressed all the way down to about 15.5x. The market has completely reset its expectations, basically punishing the stock because of that sluggish 14% ROE we talked about earlier. So, how exactly do we value this thing? Let's weigh two very different scenarios. In our bear case, we're looking at a target of 165 rupees. This happens if we see a severe breakdown in the MSME credit cycle, where stage 3 assets shoot past 3.5% and completely wipe out their earnings growth. But flip that over to the bull case, and we have a target of 450 rupees. This scenario plays out if MASFIN hits its own management target of 20,000 crores in AUM by FY28, which would finally trigger branch efficiencies and push that stubborn ROE up to 18% by FY29.
Naturally, to hit that bull case, they have to dodge some serious risks. The absolute biggest one right now, a deterioration in the MSME credit cycle. If borrowers start mass defaulting, it's going to hurt badly. There's also key person risk. Look, Kamlesh Gandhi's personal credit judgment is a massive part of their secret sauce. Aside from that, since they are an RBI-regulated entity, any abrupt regulatory changes could sting, not to mention the constant threat of net interest margin compression if borrowing costs suddenly spike. All right, Section 5, the final scorecard. We've looked at the model, the financials, the leadership, and the risks. Let's tally it all up.
So here is the exact breakdown across our 100-point rubric. They pulled a very solid 14 out of 20 on financials, really only dinged because of that 42% provision coverage. Earnings quality takes a 10 out of 15, mainly due to that ROE deduction. Valuation comes in at a fair 9 out of 15, so not a screaming bargain, but reasonable. Growth is looking strong at an 11. Risk management gets a 7 just because of the natural cyclicality of MSME lending. Management, an excellent 8 out of 10. And finally, their competitive moat rounds out the score with a 6 out of 10. Add the whole shebang up, and MASFIN walks away with a final score of 65 out of 100. This places them right in the hold or watch category for quality compounders. Basically, it's a fundamentally robust franchise, and it's sitting at a fair, though not necessarily dirt cheap price today. So what's the actual game plan here? Well, for patient investors who want a decent margin of safety, the actionable strategy is to accumulate in the 260 to 310 rupee range. Our base target over a 2 to 3 year horizon is 310 to 325, which basically just captures the expected earnings growth. But here is the critical part. Your fundamental stop loss, the ultimate thesis breaker, is if that gross stage 3 number crosses 3.5% for 2 consecutive quarters. If that happens, the thesis is busted. Before we go, I really want to leave you with this one provocative thought. Management recently put out this massive aspirational vision, reaching 1 lakh crore in AUM by 2036. And mathematically, to pull that off, they literally just need to maintain their historical 21% compounding rate for 1 more decade. So can they hit that kind of crazy scale, or is the notoriously volatile MSME credit cycle finally going to derail their 30-year winning streak? Honestly, it's a fascinating story, and we are going to be watching it very, very closely. Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor. Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions. If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update. I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next video. Thank you for watching, and keep your investing stress-free investing.